My dear students, today we will discuss module 19, which is about the management decisions, right? Basically, here we will consider two items. One is the dividend policy and one is the capital structure. In your module, it was written like capital structure and dividend policy, but in case of discussion, I start with the dividend policy first because I believe that has got some implication on the capital structure, right? So now first is the dividend policy. What is the dividend policy of a company? It is basically area of financial management, right? That you know that one of the major work of a financial manager is the declaration of the dividend, Now from tax point of view, and you also know that what are the different types of dividend. Basically from financial point of view, we have two types of dividend. One is the interim dividend, one is the final dividend. But very interestingly, from taxation point of view, we have one more dividend which is called deemed dividend, which is governed under section 222, subsection A, B, C, D and E. And I think that has already been covered to you. So you know that what are the cases of deemed dividend under those section 222A to E, right? So today what I will do, I will go for your tax implications of these dividends. Once again, the dividends are final dividend, interim dividend and deemed dividend. And so far as the tax implication is concerned, I will discuss from the two point of view. One from the point of view of the declaring company and one from the point of view of the shareholders, right? So we start with the point of view of the declaring company. Take an example. Start with an example. Say there is a company called X Limited who has got a share capital of 10 lakhs. Annual general meeting, that's the dividend declared at the rate of 30%. So if the capital is 10 lakhs, dividend is 30%, the total dividend is coming to 3 lakhs. Now whenever this company will distribute these 3 lakh to the shareholders, what are the implications? What are the implications in the hands of the company? The first implication is, which is very important, which I will discuss in detail. The first implication is the company has to pay a tax called dividend distribution tax on the amount of dividend it's distributing. Am I clear? So technically you will find that company has to pay two taxes. One is tax on its taxable income and one the tax on the dividend, right? And that is covered under section 115O, right? And this dividend is payable whether it is a dividend on equity shares, whether it is a dividend on preference shares, whether it is a final dividend or whether it is an interim dividend or whether it is a deemed dividend. It has to be paid. Now, so we know that in case of final dividend or interim dividend, the company has to pay dividend distribution tax. But what about deemed dividend? In case of deemed dividend, what I will do, I will discuss the provision up to assessment year 18-19, and from the assessment year 19-20, the entire provision has been changed. So for 18-19, what happened? Dividend under section 222A to D, this dividend company has to pay dividend distribution tax. But company need not have to pay any dividend distribution tax on deemed dividend covered under section 222 subsection E. So out of the 5, on 4 company has to pay DDT and the remaining 1 company did not have to pay any DDT. But from the assessment year 19-20, the company has to pay DDT on all 5. That means 222A, B, C, D, E. All deemed dividend which are being covered under section 222, the company has to pay dividend distribution tax. At this point I am very clear. So for the dividend, the company has to consider its cash position, because you will appreciate once a dividend is paid, a DDT has to be paid within 14 days. That means the company, now the example I have just given you, 3 lakhs. 3 lakhs, say for simplicity purpose, I am just considering that DDT rate is 15%, which is not, which we will learn later on. So for simplicity purpose, I assume that DDT rate is 15%. So 3 lakh, then 15% is 45,000. That means the company has to dish out 3,45,000. 3 lakh towards the dividend and 45,000 towards the dividend distribution tax. So company must consider its cash position before the company moves into declaration of dividend. Now in case of shareholders, you will appreciate there might be two types of, basically broadly. One is the individual and the shareholders may be a company which is called intercorporate. Suppose there are two companies, X Limited and Y Limited. Now Y Limited holds some shares of X Limited. Now when X Limited will distribute its dividend, Y Limited will get the share. So it's we call intercorporate dividend. So now while I will discuss the implication, I will consider the both intercorporate dividend and non-intercorporate dividend. First, to start with, dividend which is received. When I talk of dividend, purposely I am not including deemed dividend, which I will do separately. Now dividend means either final dividend or the interim dividend. Now in case of dividend to an individual, it is exempted under section 1034. That means since the company is paying the tax, I told you that company has to pay dividend distribution tax. So since the company is paying the tax, shareholders will not pay the tax because there is no concept of double taxation, right? But there is a new sections came maybe 2 or 3 years earlier under section 115 BBDA, which states that up to 10 lakhs of dividend it is non-taxable, but above 10 lakhs you are to pay tax at the rate of 10% plus surcharge plus cess. So now, if we mix these two, what do we find? That dividend up to 10 lakhs is exempted under 1034. Dividend above 10 lakhs is taxable, right? But in case of this 115 BBDA is not applicable to a company. So in case of intercorporate dividend, that means when a company receives dividend from another company, the entire amount is not taxable. So 115 BBDA is not applicable to a company. So this is very important. So BBDA is basically for simplicity purpose. I am not moving into very detail of it. For simplicity purpose, you can take that for an individual, 115 BBDA is applicable and it is not applicable in case of a company, right? Now, you will appreciate that the company which we talk of, it may be an Indian company, it may be a foreign company. Now, the dividend I discussed earlier, it's a dividend from a domestic company. Domestic company means basically, I think this has already been covered by you, so you know what the domestic company means. So if a dividend from a domestic company I receive, it is up to 10 lakhs is not taxable and above 10 lakhs it is taxable under section 115 BBDA. Now the question is, if an individual receives a dividend from a foreign company, it is fully taxable. In case of a dividend from a foreign company, it is fully taxable, right? Now, but in case of a company, it's very interesting. In case of intercorporate dividend, that means one company receives dividend from another company, there is a provision called 115 BBD. 115 BBD talks of that in case of a dividend received from a specified foreign company. That means I am receiving or the company is receiving from a specified foreign company any dividend that is taxed at a rate of 15% plus surcharge plus cess. Now the question is, what is a specified foreign company? A specified foreign company means a company where this company holds 26% or more of share capital, right? Suppose take an example. Suppose there are two companies, X Limited and Y Limited. Now Y Limited holds 27% of share capital of X Limited. So whenever X Limited declared any dividend in the hands of Y Limited, it will be treated as dividend received from a specified foreign company. X Limited is a foreign company. So it will be taken as the dividend received from a specified foreign company because Y Limited holds 27% of the share capital. And on that dividend, Y Limited has to pay tax at the rate of 15% plus surcharge plus cess, right? And in case of deemed dividend, if you remember, that company has to pay DDT on 222A2D, so shareholders will not pay tax on that. And on 222E, company will not pay DDT, so the shareholder has to pay tax on DDT. But this is only applicable up to 1819. From 1920, all 5 deemed dividend on which the company has to pay dividend distribution tax, so it will be exempted in the hands of the shareholders, right? Now, in case of a intercorporate dividend, the company has got some relief. What is that? It's very interesting. For 115O, I am now talking of 115O. Now, what is the relief for 115O? Suppose a holding company receives dividend from a subsidiary company. You know that the holding company concept, when a company holds 51% or more of share capital of another company, the first company is called holding company and the other one is called subsidiary company. Now, when subsidiary company will declare a dividend, holding company will receive a part of it. Now, this provision 115O states that if the holding company receives dividend from the same accounting period and the subsidiary company has already paid dividend distribution tax, then the amount which the holding company received from the subsidiary company will be deducted from the total dividend. Right? Do you get the point? Because it's a very interesting one. I'm just clarifying it. Why this is so? Because subsidiary company is paying the dividend distribution tax, right? Say subsidiary company paid dividend 100 and the holding company holding is 60%. So while subsidiary company declares dividend, distributed dividend, it paid DDT. Now out of this 100, holding company will get 60% or 60. The holding company will credit it to its profit and loss account or included in the profit and loss statement. And whenever they pay dividend, their dividend includes that 60. So if they pay DDT, there will be double taxation. So this should be deducted. And secondly, if this company receives any dividend from a specified foreign company, which is taxed at the rate of 100 section 115 BBD, then that is also been deducted. So, in a nutshell, whenever a company declares a dividend, from the total dividend, they will deduct dividend receipt from the subsidiary company and they will deduct dividend receipt from a specified foreign company. And on the net amount, this company has to pay dividend distribution tax effectively at the rate of 20.35765%. I think this is clear. So this is all about a dividend policy from the point of view of the company and the point of view of the shareholders. Now you may raise a question, what is the tax planning, sir? What is the tax planning? Now, basically, tax planning is whenever you pay dividend, you must consider your amount of cash available, plus you must also consider the total dividend distribution tax you got to pay accordingly. And one thing which is not directly, may not be related to your syllabus, but I think you can make a comparison to your bonus shares. Now, what company can do, they can some year they can go for dividend, but sometimes company may say that I can issue bonus shares. Now, what is the tax implication of the bonus shares is, whenever you issue bonus to the equity shareholders, it doesn't have any tax implication in the hands of the company or in the hands of the shareholders. Only when it is being sold by the shareholders, then it is charged capital gain in the hands of the shareholders and company doesn't have any tax implication. So for the bonus to equity shareholders, a company doesn't have any tax implication. But if the company issues bonus share to the preference shareholders, that will be treated as deemed dividend under section 222 subsection B, and the company has to pay dividend distribution tax at the rate of 20.35765%, right? And in the hands of the shareholders, once again, nothing is taxable. When they sell it, it will be taxable under capital gain, right? So company can think over, this is my own input, that you can go for one bonus share or dividend, because you know that dividend what will happen. So this is all about the dividend policy. Next subtopic I move with in the management decision of the capital structure. Now what is the capital structure? Basically capital structure refers to various mode of financing your capital structure. Now the question is how that impacted my decision making. What I will do, I will give you a comparative chart between the debt and the equity. You know, debt means basically debt is a, you know that capital is of internal and the external. This is a part of the external capital. Now debt and the capital. Now suppose if you are financing through debt, so I will go point wise. This will be subsequently definitely supplied to you. Number one is interest on debt, maybe debenture, maybe loan. It is tax deductible, right? Subject to 40 small b. 40 small b talks of what? That if you remit this interest outside India, you got to make TDS, and the 43b which talks of some interest has to be paid within a specified time, right? But in case of equity, when you pay the dividend distribution tax, it is not tax deductible, right? So interest on debt is tax deductible, but dividend is not tax deductible. Secondly, dividend you got to pay DDT at the rate of 20.35765%. It is not applicable in case of debt, right? And thirdly, the cost of raising the debt is tax deductible. Cost of raising the debt means suppose you pay some brokerage and blah blah certain expenses, that is tax deductible. Plus what you can do, if you incur these expenses before commencement of your business, it can be capitalized. But in case of cost of issue of your equity shares, it is a capital expenditure and hence it is not allowable. But what you can do, if you incur this expenditure before commencement of business, you can take this as a part of your preliminary expenses, right? Then fourth point is during the lean period, means when the company is not running very well, interest is a burden, because you know interest is a charge against profit. Whether you have a profit or loss, you got to charge interest. But during lean period, if you don't have any profit, you may not pay any dividend. So during the bad period, lean period or the bad period of business, so maybe equity is good, your debt is not. But from tax point of view, planning, what should we do? Should I go for entire equity, or should I go for equity preference, or should I go for equity preference debt? So that depends on which will give you the highest EPS, that is earning per share, or where the market price per share is the highest, or return of equity is the highest, right? We will take that one. But basically, as a clue I am giving you, whenever you mix up the debt, your EPS will be increasing, because debt is tax deductible, debenture, and your dividend is not. Thank you.